If you're investing in real estate, one of the biggest decisions you'll make is choosing between short-term rentals and long-term tenancies. Both can be profitable here. Both can build wealth, but they behave very differently. And choosing the wrong model for your market, for your lifestyle, can cost you time, money, and peace of mind. In this video, we're breaking down the profitability, vacancy patterns, operating costs, and best fit markets for each strategy here, so you can decide which one aligns with your goals. Let's get into it. Short-term rentals, think Airbnb style stays, are known for one thing: high gross income potential. In the right market, a short-term rental can earn 1.5 to 3 times what a long-term tenant would pay. Why? Because you're charging nightly rates, tapping into tourism, business travel, medical travel, and event-driven demand here. But here's the catch. Short-term income is volatile. It rises and falls with seasons, travel trends, and competition. Now compare that to long-term rentals. Long-term tenancies offer steady, predictable monthly income here. You won't see the same explosive highs as short-term rentals, but you also won't experience the same dips. If your goal is consistent cash flow, long-term rentals deliver exactly that. Vacancy is one of the biggest factors that separates these two models. Short-term rentals often operate with 50 to 80% occupancy, depending on the season and the strength of the local travel market here. That means you're constantly working to keep the calendar full. Long-term rentals, on the other hand, typically have much lower vacancy. Once a tenant signs a 12-month lease, you're usually set for the year. Vacancy rates often fall between 3 and 8%, making long-term rentals far more predictable. If you want stability, long-term wins this category easily. Short-term rentals come with higher operating costs and a lot more moving parts. They're responsible for furnishing the property, paying utilities, cleaning and turnovers, booking platform fees, guest communication, higher maintenance, and often stricter insurance and licensing requirements. These expenses can eat up 35 to 55% of your revenue. Long-term rentals are simpler here. Tenants usually pay their own utilities. Turnover is minimal. Maintenance is predictable here, and management fees are lower. Operating costs typically fall between 20 and 30%, making long-term rentals easier to manage and more hands-off. Short-term rentals thrive in markets with strong tourism, business travel, medical travel, event-driven demand, or limited hotel supply. They're perfect for investors who want high returns and don't mind a more active management style, or who have a great property manager in place. Long-term rentals shine in stable, growing cities, suburban neighborhoods, workforce, housing markets, areas with strong employment, and places where STR regulations are tight. They're ideal for investors who want predictable income, lower risk, and a more passive experience. Here's the truth. Neither strategy is better. They're simply different tools for different goals. Choose short-term rentals if you want maximum revenue potential, flexibility in pricing, a high yield, high engagement investment. Choose long-term rentals if you want steady, predictable cash flow, lower vacancy risk, minimal management, a foundational, low volatility asset. And for many investors, the best approach is a hybrid strategy, using long-term rentals to anchor stability and short-term rentals to boost overall returns. Short-term rentals and long-term tenancies both have the power to build wealth, but only when you match the right strategy to the right market and the right investor profile here. If you found this breakdown helpful, hit like, subscribe, and drop a comment below. Which strategy are you leaning toward, short-term or long-term? Thanks for watching, and I'll see you in the next video.